Hi guys. Welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about how to invest with confidence. So make sure to watch the full video. The stock market is down more than 20% for the year, and this could not have come at a worse possible time. After all, inflation is currently at a 40-year high, so the purchasing power of every dollar we earn is worth less than just a year ago. Meanwhile, the values of various cryptocurrencies and non-fungible tokens, NFTs, are dropping like a rock, and this is despite the fact that crypto has consistently been sold to the public as a hedge against inflation. Investing with confidence in these crazy times. With all this being said, plenty of fortunes have been made during times when it seems like nothing is going right. Remember when the Dow Jones Industrial Average spiraled down to just over 20,000 during March of 2020, when we were in the midst of the darkest days of the pandemic? Investors who bought the market during those days and in the months that followed saw the Dow surge to over 33,000 by the end of March 2021. This means that, if you invested during the beginning of the COVID-19 pandemic, you would have seen a more than 50% return over the course of just 1 year. Get nerdy with data. Financial advisor Melanie Simons of Reframe Wealth says that looking back at historical investing data, or getting nerdy as she calls it, can help us feel better about where we're at right now. It's only natural to feel aversion to loss, but a couple quick calculations that incorporate probabilities and historic return will give you a sense of the real damage that a market has caused. Simons adds that, when markets are down 20% plus, it can be easy to wonder how you'll ever make up for those vanishing dollars. Don't time the market. According to financial advisor Andrew Westland, who works as a financial advisor for Betterment, trying to time the market is one of the biggest mistakes investors make during times of market turmoil. In other words, they might try to buy stocks or other securities at their lowest, then sell at their highest, which can be difficult to execute when you don't have a crystal ball. Trying to time the market can also mean selling investments before they hit the bottom to avoid substantial losses, then buying back in at just the right time. Stick with your plan. If you have a carefully thought out investing strategy in place, then you likely do not need to worry whether the market is up or down this year, next year, or pretty much any time in the future. If you don't have an investment plan, then it's probably time to come up with one or reach out to a financial advisor or a robo-advisor for help. Financial advisor Erica Arroyo of MA Private Wealth says the investors and retirement savers who are concerned about dropping balances should evaluate the strategy they have in place first and foremost. Because strategy is absolutely critical whether the market is up, down, or sideways. Arroyo says her firm advocates for a well-designed portfolio that is diversified among many asset classes and making tactical adjustments if needed. Don't pause contributions. Financial advisor Thatcher Taylor of ProPath Financial also adds that far too many people stop contributing to their investments or their retirement accounts when markets are down. They don't want to see their new contributions drop in value any further, so they stop contributing and wait to invest until markets turn around. This is a huge mistake for a few reasons, the most important of which is that down markets provide an exceptional opportunity to buy stocks and other securities when they're on sale. Focus on what you can control. Finally, forget checking your balances every day and spend your time and energy on something that can actually pay off. Financial advisor Justin Stevens of O'Keefe Stevens Advisory Incorporated says it's smart for investors to focus on daily activities instead of results anytime, but especially right now. For example, make sure you are saving and investing a large percentage of your gross pay. If you're not, now would be a great time to look at your monthly income and spending with the goal of finding extra money to invest. He says if you're saving into your employer-sponsored plan, look at the number of shares you are buying, not the dollar amount. Also, make sure you have an investment plan in place that you can stick to. A good place to start is to figure out exactly how much you will need to retire at a specific date in the future. With this target, you can back into the rate of return you need to achieve, based on the amount you are currently saving. If you're looking for a tool that can help, play around with some figures using the compound interest calculator at investor.gov. If the rate of return falls between 5 to 8%, Stevens says there's probably no need to make changes to your savings plan. If you find out the return you'll need to reach your goals is higher than that, however, increasing your savings rate during a bear market could be an opportune time to get caught up and on track. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.